Israel is preparing to attack the Iranian energy facilities and is awaiting green light from the US. Meanwhile, at the same time, US intelligence has warned that Iran is unlikely to ease the Strait of Hormuz chokehold anytime soon. The geopolitical landscape is still escalating quickly, but what does it mean for the financial market and what type of opportunities lie ahead for the next few days and weeks? Let's understand it step by step in this video. Before we move on to anything next, I would like to share that our quarterly month verified P&L statement is out and we made 10.8% in profits this quarter. Since November 2025, we are up 20.56% and all of our verified P&L statements are available in the pinned messages of our public Telegram community, and I will drop its link in the description so you can check out the results and even join it for trade ideas, macro updates and more. Now moving on to the video. Now, in this video, we will go on everything step by step. We will go through everything step by step because the thing is that we are seeing conflicting headlines, which is confusing the traders and the markets. At one point, you see a headline which says that the Iranian war is going to end, and at the other minute, you see a headline which says that we are going to launch a ground operation in Iran. It is confusing the markets and is confusing the traders as well, due to which I see that many traders have been blowing their accounts. So in this video, I will try to put everything in as simple way as possible and step by step so you can navigate your own direction. And at the end of the video, I will give you some possible trade ideas as well for the next week. So make sure you remain stick to this video and watch it till the end. Now, first of all, talking about the sentiment. With our MRKT AI sentiment index, it is pretty clear that we are in a risk of market environment due to inflation fears rising, due to supply fears, due to growth fears, and everything which is happening with the Middle East recently. On the other hand, on Friday, we got our NFP data and the unemployment rate ticked down to 4.3%. Meanwhile, the headline NFP numbers came at 178K. Overall, this was a very strong NFP number, quite a A plus NFP report, and it gave the room the Fed to hold interest rates for even longer going into the future if the inflation concerns continue to rise and if the labor market remains stable. If we see on our MACD terminal, we can see that old remains bullish on the higher time frame and on the intraday time frame as well due to the escalating geopolitical tensions. We have our demand area sitting around $100 per barrel level with our target sitting around $120 per barrel. And obviously, if you see the fundamental factors which are supporting this bias, mainly it is due to the escalating geopolitical tensions, the risks of a ground invasion in Iran by the Americans, and due to the Strait of Hormuz being closed, supply fears, and all of that stuff. And oil prices are directly impacting the US indexes as well. We see that SPX is slightly bearish on the intraday time frame. And if we move on to the intraday time frame specifically to see our target and pullback areas, we can see our pullback area was around 6620s and markets the SPX it nicely rejected from that and is heading towards our target levels around the 6400, 6500, something like that. And again, if we see the fundamental factors which are supporting that bias, it is again going to be the major geopolitical tensions, the supply fears, rate hike expectations, inflation fears, growth fears, and all of that stuff. But again, here is something pretty important. If you see gold, right now we can see that gold is bullish on the intraday and on the higher time frame, and it is being supported by the fact that supply fears, the geopolitical tensions, inflation fears, they are generally positive for gold. But here is another side of the coin right here, which many traders are missing. We will move on to gold a little bit later and understand the story behind it, but first let's just understand the SPX. On our MRKT terminal, we can see that SPX is bearish on the intraday time frame, and let's just understand the technical setup on it. Right now, I took a short on SPX, and overall, if you see from a technical perspective, initially we were seeing a continued upside move in SPX. Later on, we went into a consolidation, and after that, since the Iran war started, we broke out that consolidation right here, and since then we are continuing lower with higher highs, higher lows, higher highs, higher lows. And based on the same pattern, based on a risk of market environment, based on the Iran war still escalating, I took these shorts on the SPX, and currently I have an open TP on it, and I will manage it according to the developing situation. And even on the other hand, let's say that that SPX it was stop loss and it continues higher, I won't mind that unless and until the situation remains the same, unless and until we have inflation fears, unless and until rate hikes are the narrative, unless and until the supply fears related to oil remain elevated, unless and until oil prices remain elevated, because all of this, it directly negatively impact the SPX. It increases your borrowing costs, it increases the expectations of inflation. Obviously the rate hikes, due to the higher inflation, due to the higher oil prices, you will likely get higher interest rates for longer, which will increase your borrowing costs. It will reduce the profits of your companies, of your stocks, and all of that stuff. And investors also at the same time, when they see that the interest rates are expected to rise, instead of investing their money in a risky environment, in some type of risky assets like the stocks, they invest their money into the bonds. Okay, so they can lock out some type of a specific return, some type of a uh, certain return. That is why investors pull out their money from the indexes and they pull it in the bond market. Okay, that's why as long as the narrative of escalation, as long as the narrative of inflation fears, it remains in the market, I will remain bearish on the SPX, and any pullback, any bounce will likely be a selling opportunity for me. And overall, this is what we have been seeing in the market since the Iran war started. We go lower, buyers try to take control, we see a dead cat bounce, but sellers pull back in the markets and move it more lower. Dead cat bounce, more lower, dead cat bounce, more downside, and another dead cat bounce, and it is very likely that we will see more downside and a new type of lower low from here. And even if we don't, even if we test around like stay the 6750s or even the 6850s, 6900s, something like that, as long as the fundamental narrative remains the same, I will remain bearish on the SPX. Now, here is one more thing which you need to understand before we move on to understanding the situation in gold, or before you can navigate the markets yourself. It is about the bond market. Okay, since the Iran war started, we are seeing a continued upside move in the US 10-year Treasury yield. Now, the question is that what is the signaling? Now, this stuff may get a little bit boring, but the thing is that this boring stuff actually works. It will tell you the why behind the markets, and it will help you to navigate trades yourself, to filter out the noise from the markets. That's why it is going to be very important to understand it, that what is happening here and why is it important and how it can shape the markets. So, in very clear words, what is happening here? If the yields are rising, it means that the investors in the bond market, they are demanding higher return, because maybe for now the reason is that because of higher inflation expectations, we are seeing elevated oil prices right now, and due to elevated oil prices, they are going to feed directly into your production costs, into your goods, into your transportation costs, into your basket of goods, into your raw materials, and all of that stuff, due to which you are expecting that we may see an increase and uptick in inflation going into the future. And to due to this, the participants, the investors, the whales, the traders in the bond market, they are demanding higher return. In very simple word, if this is going higher, it will mean that the participants in the bond market are expecting higher interest rates. Okay, due to, as of now, it is due to the inflation fears. Oh, I hope that you are getting my point. So, if this thing continues to rise, it will mean the markets are fearing inflation, and it will eventually mean that it is going to act as a negative catalyst for gold, for the indexes, for Bitcoin, and as a positive catalyst for the dollar. And that is exactly the reason that since the Iran war started, since all of the situation in the Middle East started, instead of going higher, gold prices started to move lower. Why? Because you are expecting rate hikes, you are not expecting rate cuts. So investors, instead of investing in gold, they went and invested in the assets which were available at more discounted prices, like the dollar, like the oil, or the invested in the bond market, because they were guaranteed to give them some return because of their discounted prices and because of higher inflation expectations. That's why investors pulled their money out of gold, pulled their money out of the stock market, and they put it in gold, put it in the dollar, put it in the oil, and put it in the bond market. But this narrative can shift within a few days. Now, a little bit of tricky part is going to come, but before we move on to that, I want to make sure that one thing is pretty clear so far. If the oil prices are going to remain elevated, if the 10-year treasury yield is going to remain elevated, it will mean they are fearing inflation. It will mean that the participants in the bond market, in the oil market, the markets, they are expecting more escalation, they are expecting more uncertainty. And as long as that uncertainty remains, for me, every pullback in the SPX will be a selling opportunity. So this is one trade idea for you going into the next week. Right now I'm in shorts, but even if this one hits my SL, I will still looking for shorts at higher levels, maybe around the 6750s or even the 6900s, as long as the current narrative remains valid, remains present in the markets. Now we have to understand about gold and look for a possible trade idea on gold as well going into the next few days and next few weeks. First of all, heading to our MRKT terminal and seeing our higher time frame bias, we can see that the higher time frame bias on gold remains very much bullish, with our pullback area sitting around the $4,500 levels and targets around the 4850s, or even they can be extended to 4900s as well. But here is one more thing. First, let's just understand that what is supporting this. The main factor supporting this is overly the geopolitical risk, but at the same time the real yields decline. What it means and how it is going to impact the gold and what is my bias, let me just explain this to you in simple words. As of now, I remain a little bit sidelined on gold. When you talk about from like a long-term perspective, I remain bullish on gold. But when you talk about from a short-term perspective, I remain a little bit sidelined and I'm waiting for some type of clarity. Now, what is that going to be? That type of clarity? It is going to be from the bond market again and from the oil prices. Now, since the Iran war started, we were seeing some upside in that 10-year treasury yield, but recently we are seeing some type of a topping out pattern, and maybe very possibly it can continue to the downside even more. The question is why. But before we move on to this, we have to understand that MRKT literally told you this thing as well. While the inflation expectations are rising, the yields are declining. It means the real yields are in a structural decline. It means that the return from the bonds, from the government bonds, is not as looking as attractive as it was previously, due to which investors are more likely to invest in gold now rather than the bond market or something else. So MRKT already told this, explained this in a well structured way, and also converted this in a trade idea. Along with this, we have some more things like the central bank buying. The central bank buying is still continuing. We are still seeing central banks continuing to add more and more gold reserves. The demand of gold is still active. So when you talk about from a long-term perspective, gold remains bullish. Now we have to make an equation for you to make it even more understandable, for you to make it even more easy. And I will be making equation just right now. So here we have our very simple equation. If the 10-year government bond yield, now you have to understand that markets right now are moving on two things, the oil prices and the bond market. Because one thing will signal the inflation fears and the second thing will signal the growth fears. I will help you understand that what this means and how you can navigate the markets yourself with the help of this. The thing is that if the 10-year treasury yield and the oil prices both remain elevated, both remain higher, it will mean that the markets are more concerned about the inflation, about the uptick in inflation, and this will mean that the markets are expecting rate hikes into the future. And rate hikes are negative for the indexes because it increases the borrowing cost, and is negative for gold as well, because gold is a non-interest yielding asset. And instead of investing in an non-interest yielding asset in an environment of rate hikes, investors simply go and invest in the bond market or simply invest in the dollar as well, because it reduces the circulation of money, the supply of money, and strengthens the dollar. But there is another narrative which can support gold in this cycle, which is that if the 10-year treasury yield declines, meanwhile the oil prices remain elevated, it will mean that the markets are more concerned about growth now rather than the inflation. And if this becomes the case, it will mean it will you can say in simple words, it will act as a positive catalyst for gold but a negative catalyst for the indexes. A negative catalyst because this will increase the recession fears, this will increase the uncertainty. Investors will pull their money out of your economy, out of your stock market, because they are not seeing that much of growth potential. And at the same time, they will invest in gold. They will also take their money out of the dollar because they are not seeing that potential in your economy. It's simply human psychology, okay, investor psychology. So they will simply do what? They will simply go and invest their money in gold and take it out from the indexes, take it out from the dollar as well, and invest everything in gold. Why? Because gold is going to be the safe haven. Gold is going to be the supporting factor or the most supported asset in a recession environment. Okay, when there is uncertainty, when the economy is not expected to grow. Now this equation goes much more longer than this for more clarity, but right now we will keep it simple. So the equation again, repeating it, if this becomes the scenario, elevated bond mark, elevated yields and elevated oil, then the markets are focusing on the inflation. It means market are expecting the rate hikes, and it will act as a negative catalyst for gold and a negative catalyst for the indexes and a positive catalyst for the dollar. But on the other hand, if the 10-year starts to decline meanwhile the oil prices are elevated, it will mean that the markets are focusing on the growth fears, and it will act as a positive catalyst for the dollar, sorry, positive catalyst for the gold, and a negative catalyst for the indexes and for the dollar. And that is exactly why, like, this is the reason, the inflation fears is exactly the reason that gold prices initially went into a structural decline even with the Iran war. Many traders on the social media and every other platform, they were not understanding this, but it was pretty clear that if a war is causing higher inflation fears, meanwhile your economy and labor market is stable, then obviously you will see a structural decline in gold. And also at the time where the gold market was already trading at a premium price. So this is the thing about gold, and I hope it's pretty much clear now. Now moving on to a trade idea. So for a trade idea on gold, we will still need to keep an eye on something. On our MRKT terminal, we can see that the higher time frame and the intraday time frame biases are bullish. We can see the supporting factors, and obviously the main factor is going to be the real yields decline. But the thing is that if you see the real yields, we are in overall a structural decline. Okay, from a short-term perspective, like since this. But here is one more thing which you need to keep an eye on, and it is going to be that you have to see if this actually keeps on going to the downside meanwhile the oil prices are elevated. If this really becomes the case, which is looking like it will become the case, but still we'll still need to keep an eye on this. If this really becomes the case, then it will mean markets are fearing growth now instead of inflation, and that will obviously ultimately provide some support to the gold. As I told you earlier, that as of now I am a bit sidelined. Okay, if we move on to our 4 hour time frame, right now I'm not looking for any type of sells, but overall, again, from a higher time frame perspective, even from a medium term perspective, I continue to follow what MRKT is saying. I continue to align with the MRKT. MRKT is looking bullish, and I remain bullish as well, as I agree with the reasoning it is giving, like the central bank buying, like that real yields decline and all of that stuff. Majorly I will be monitoring this pullback area around the 4500s, 4400, something like that. If at that time I see that the yields are indeed declining meanwhile we have elevated oil prices, then I will be looking to buy for some long term at this pullback area, maybe even targeting this accumulation area around the 5200s. Okay, so gold, for gold right now, as there is less clarity in the short term, that's why I'm looking at the higher time frames. So for gold, I'm not looking at active trades, but if I get a deeper pullback, I will obviously be very interested in buying gold or even investing in gold, accumulating some gold, even from a long-term investment type of perspective. So this was pretty much it about gold, but now we have to a little bit understand about the oil prices as well, or what is happening with them. So the thing is that about the oil, currently, to be very honest, I am not actively trading oil, because the most clear trade right now, the most well aligned trade right now is going to be the shorts on the indexes. But we will still need to keep an eye on oil and keep an eye on the dollar as well, because if oil prices continue to move higher, if we continue to see more and more supply fear, supply disruption, or even if we launch a ground invasion as well, then oil prices can remain too much elevated for too longer. Okay, overall, I even if I have to buy or even if I have to actively trade on oil, I don't think so that I will be looking at current levels to buy. Okay, we are nearing a supply area. It was also the top of the Russia-Ukraine invasion, something like that. So I don't think so. I will be interested in trading near this area. But it is also very much a possibility that next week, initially in the first half of next week, we can see this wick fill as well. Before we maybe see a profit-taking move, something like that, and after that we can continue higher. But overall, first I will be waiting for some type of a wick fill, and after that I will be waiting for a follow up profit taking move before I buy oil again and join the ride. Right now at these elevated prices, I don't think so that it is going to be worth it. Overall, again from a fundamental perspective, oil remains bullish. If we see from our MRKT terminal as well, let's see the target levels pullback area as well on oil from our MRKT terminal. Okay, so from a higher time frame perspective, it remains bullish. We have our pullback areas sitting around $100 per barrel levels. If we see from a day trading perspective, we have it around $110. So maybe from a day trade perspective, from a scalp perspective, we can try at this area going into the next week as well. But the targets will remain minimal. The targets maybe will remain at this week fill as well. So possibly, very possibly, if we see a pullback going into the next week, sorry, if we see up, yeah, if we see a pullback at this area, something like that, maybe this or maybe even this previous breakout high. Okay, if we see something like that, then possibly I will be looking to buy oil from a day trade perspective, and I will be targeting $120 per barrel level, or maybe even from this level and targeting the $120 per barrel level. But I won't be holding this for long, from a swing trade type of perspective or from a higher time frame trade type of perspective, if I don't get a deeper pullback to the 94, 95, or even the $100 per ounce level, this accumulation area, something like that. So yeah, this is pretty much it about the oil and also about the dollar. Let's discuss it as well. The thing is that the dollar, as long as the oil prices are elevated, as long as the scenario or the narrative is becoming rate hikes, the dollar is expected to remain elevated as well. And if you break out from the zone, dollar can very well test this 1 or 2.5, something like these levels going into the next few days or next few weeks, because elevated oil prices will increase your inflation, will pour into the inflation fears, and they will increase the expectations of rate hikes as well, which will directly support the dollar. Okay, but the other side of the coin, which I told you earlier, that if markets move on from inflation fears towards the growth fears, then obviously we can see some structural decline in the dollar as well. Right now, that's not the narrative, but that can very well become a narrative as well. And everything obviously is being reflected in our MRKT terminal as well. From time to time, we have our fundamental factors, we have our live headlines, and by clicking on this brain icon right here, you can actually get a AI summary of the live headlines as well, along with the market impact. We have our market sentiment as well, we have our Trump tracker, and a lot of stuff we have in this. By the way, I will drop the link of this tool in the description as well. If you want to try it out, you can try it out from the link in the description, and I will drop the link of my socials, my Telegram in the description as well. So if you want to join them for trade ideas, macro updates, and more, you can join them as well. This was pretty much it for the video, just revising it a little bit. I remain bearish on the indexes, on the US indexes, until something changes, and on any type of pullback, any type of retest of higher levels, higher supply zones, I will be looking to sell that. Overall, as of now, if the current narrative remains, I am targeting the 2025 pre the initial all-time highs of the 2025. Okay, so this will remain my target. And for gold, as of now, I'm sidelined, but from a higher time frame perspective, I remain bullish on gold. And if I get a deeper pullback to 4500s or 4500s, 4400, something like that, then I may look to take a stab on gold or even buy it from an investment type of perspective. For oil, from a day trading perspective, from a scalp type of perspective, or even a intraday trade type of perspective, I will be looking if we can get a pullback, something like this, something like here, to 102, 103, 104, something like that, or maybe here around 107, 108, and I will be targeting the previous highs around the $120 per barrel level. Overall, from a swing trade type of perspective, I don't think so. I will be buying oil until I see a deeper pullback. And if anything changes, if the narrative change, if we see a new headline, something like that, I will update that timely on my socials, on my public telegram, and all of that stuff. This was pretty much it for the video. If you have any questions, you can ask in the comment section, and make sure you like and subscribe the channel, so my video, like, it will simply help me with the algorithm and nothing else. This was pretty much it. Best of luck for the upcoming trading week.